Welcome to Getting Rich with Rich. I'm Rich, founder of Under the Radar Report. It doesn't get any bigger than the changing of the guard in the US. And if there's one key message for investors, it's keep calm and carry on. Seriously, what business loves is certainty, and that's what the US voters gave us. They gave us certainty in spades. There's more certainty of corporate taxes being cut from 21% to 14%. There's more certainty that 2017 personal tax cuts are going to be extended. There's more certainty that there's not going to be an ugly transition. There's more certainty that the US will pursue an America First policy. This means exporting to the US will become more difficult. The proposal is for universal tariffs on all imports to be at 10 to 20%, 60% for Chinese imports. So tariffs are not taxes, and to hell with the debt consequences. That's the philosophy of the incoming Trump administration. I view tariffs more as a tactical threat, and how this plays out is actually highly uncertain. Any stocks in your portfolio that rely on exports, you need to be careful about. So Treasury Wine Estates could be an example. Another, shade cloth manufacturer, Gale Pacific, vehicle accessories specialist, ARB Corp. Austal is another example, but like in our view, the shipbuilder is too big to fail. Basically, they've got two shipyards in Alabama. They're a key supplier to the biggest customer in the world, the US Navy. You know I love Austal. But renewable stocks are where there is more risk. These have been sold off in the US due to the intended removal of the green tax incentives. But there just aren't many pure renewable stocks left on the ASX. I mean, we own GenX Power, that's been taken over. But like a lot of the renewables exposure is now at the big end of town. You know, the utilities, AGL, Origin Energy. But these are highly diversified companies, so we're comfortable with these stocks. Look, inflation expectations are being priced in, but not aggressively. Look, the 10-year US Treasury yield increased 14 basis points on the announcement to 4.44%. This is a long way from where it was this time last year, where it was close to 5%. So, basically, the world is not coming to an end. The world is not coming to an end. So, put simply, what we're seeing in the US with that boost is the sugar hit from those big corporate tax cuts. But it's similar to what we saw when the Chinese announced their huge stimulus package back in September. There was a big rotation into resources and, out of banks on the ASX. But since then, there's been, a calming effect. And certainly the stimulus measures weren't quite what people anticipated or what people had hoped. Investors underwhelmed, and basically there's been a reversal of that rotation. Time has a way of evening out expectations. That's what happens in the markets. It's a fact that inflation around the world is under control. It's moving back to 3% in the US market, which is the same effect here and in Europe. So unemployment is not high. That's another fact. It's also a fact that people are finding life very hard in terms of making ends meet. These are the facts which the companies that we own are dealing with every day, just like we are. The fundamentals of the companies have not changed. They're still the same companies. There will be some effects, but what we do is work out what's priced in at any given moment and how that measures up to our expectations. So we're contrarian investors here at Under the Radar Report. That's why we've been focusing on commodities producers that have been doing it tough in recent times. One example, Lynas Rare Earths. That's been doing it tough because the rare earths price has come back to earth. I can't believe I said that, but it's true. And they've had production issue after production issue over the years. But things are coming good for them, and we're seeing that reflected in the boosting of the share price. We are able to look at these investments over long periods of time, and we can tell when times are good for them and when times aren't, and what's priced in. That's the experience we have. Sometimes stocks do fall out of bed. Like, that's what happens. But we spend our time looking closely at the fundamentals, the balance sheet, the cash reserves, the liabilities, the operating cash, the profitability, and we don't panic. That's why people subscribe to us, because we don't panic. The more information we have, the better we're able to handle uncertainty. So we've downgraded one stock that's come off a bit, Mach7 Technologies, but we're not panicking. We're holding firm. They had a poor quarter, but a poor quarter does not make a year, and they've held on to their guidance for the year. Look, we're watching this stock, but what they do have is a very strong balance sheet with over 20 million in cash. They're not burning much cash, if any. They're on the road to profitability. They're a company in transition. There's going to be bumps in the road. The big advantage investors have at the individual end of things, like us, is patience. That's where we make the big money. Some of the best returns we've had have been from stocks where initially we got it wrong, like Macquarie Technology, Codan, Neuren Pharmaceuticals. These stocks have increased tenfold. They didn't go to plan from the get-go, but we didn't panic. Look, we won't always get the timing right, but we make sure we cover for eventualities, good and bad. When you panic, you often lock in bad decisions. What's coming up? New stocks, new stocks, new stocks. We've got more analysis on critical minerals. We've got more stock opportunities in critical minerals and more stock opportunities in the industrials. There's so much to look forward to under the radar.